Welcome to Volatility Trading Strategies. So recently I was going through my old account statements, basically just to try to assess how I did when I first started trading these products. And here's the first trade that I ever made. On August 9th of 2010, I bought 3,000 shares of VXX. And it's funny, I still remember that trade. Looking back on it today, there's a few things that stand out. First, it actually made a small profit, so it was a pretty good start, albeit a little bit lucky. Second, the volume that day was only 47,000 shares, so I actually purchased about 6% of the total volume that day. And a week later, my trade was 10% of the total volume, so they really weren't very active at all. And lastly, clearly I didn't quite know what I was doing just yet, because when I look back on the volatility metrics, they weren't that favorable at all for that trade. To be honest, if I had a time machine and could go back to that day, I'd probably take the opposite side of the trade. It took me a few months to really understand the product and to develop a strategy around it. Back then, nobody knew what it was. There was no media attention, almost no articles at all, aside from a few blog posts here and there. Later that year, I started writing articles on them, talking about trading volatility as an asset class, but I don't think anybody really cared to read them. Well, now fast forward to 2017, and investing in volatility products has exploded in popularity. There's new websites popping up all the time with 2020 hindsight, eye-popping backtests being published, people talking about it in financial chat forums, in comment sections, on Twitter. In my first few trades, I was buying 5 to 10% of the daily volume. And now my trades are probably 0.001% of the volume. I wouldn't say it's mainstream yet, but it's getting there. And as a result, the financial industry is scrambling to release new products to get investors interested in buying them. This is big business now, and there's lots of volatility products on the market and new ones being launched all the time. When I update this article in a few years, I don't think I'm going to have enough space up here to accommodate how many there could be. But to be honest, quite a few of them are just low-volume clones of the more popular products, and some of these other ones are just downright too dangerous to be investing in. So in this video, I'd like to help investors out and maybe narrow down this field a little bit to a few of the better choices. So let's get into this. Now, before I get into a few of the good ones, a few words of warning. None of these exchange-traded products are similar to the ones that you're used to investing in. They aren't like the SPY or TLT or the GLD, where for certain portions of your portfolio, you could feel comfortable holding those for the long term. I'm not exaggerating when I say that none of these volatility products are suitable buy and hold investments. So if you're looking to dip a toe in the water, so to speak, you're going to have to acknowledge that on some level, you're going to need a tactical strategy that moves in and out of these products. Buy and hold is not an option here. But that still begs the question, which ones should we focus on? So I'm going to introduce what I personally feel are the 3 best volatility pairs, and we're going to start with the originators of all of this, and that is the VXX and the XIV. VXX launched first on January 30th, 2009. So when I was making my first trades, the XIV didn't actually exist yet. That launched later on November 30th of 2010. But this pair has been around the longest, and it's still the one that I use to this day for my main tactical volatility strategy. Now, this video would be way too long if I explained how they actually work, so for that you can check out my website. But for our purposes today, the XIV is an inverse volatility product, which basically means that when the markets are calm and volatility is decreasing, it tends to be a tailwind for the XIV. The VXX is a long volatility product that tends to do well when volatility rises, and it can rise substantially quick if there's an actual sell-off in the broad markets, like a recession, for example. So massive oversimplification here, but essentially XIV for bull markets and VXX for bear markets. These are the originals, and they're so popular that they've become like those products that become synonymous with the segment itself, like Scotch Tape, or Kleenex, or Sharpie, Jet Ski, Novocaine, or for all my Canadian friends out there, Zamboni. These days, when people refer to the short volatility trade, oftentimes they just call it XIV, even if they're using a different product to execute it. XIV is synonymous with short volatility, and VXX is synonymous with long volatility, so you can't go wrong just sticking to the originals. However, the XIV has one potential downside that needs to be addressed. In the prospectus for the product, there's what's called an acceleration clause, and essentially what it says is, if there's a market event that drops the price of XIV over 80% in a single trading day, the product can be terminated. Now, even though XIV is the only inverse volatility product to specifically talk about this acceleration clause, the truth is that all the one-time short volatility ETPs are more or less in the same boat. They're all going to want to close before the value goes negative. Now the question becomes, how much of a concern is this really? Is it possible for these products to lose 80 to 100% in a single day? The short answer is yes. Now, in a practical sense, the odds are pretty low, but it does need to be said that this is technically a possibility. And if you view it through the lens of quantum mechanics and Murphy's Law, one might be inclined to say that on a long enough time horizon, it's not only possible but likely. The Black Monday crash of 1987 would easily have done it. So whether an event like that can happen again in the future is up for debate. But the way I look at it is, acknowledging that volatility products can go to zero in a single day is valuable. It makes the trader put risk management at the forefront of their strategy building. It means that no matter how badly we want to get aggressive and shoot for huge profits, as responsible traders, we just can't. Nobody knows if and when this type of event will occur, so really the only line of defense is making sure that we're only allocated to trades during the most ideal times and making sure we're in cash for all of the rest. Here's a chart of the largest single-day XIV drop since the product launched. You can see the record there in 2016, the day of the Brexit vote. The VIX spiked 49% and XIV crashed nearly 27%. Now you might say, well, 27% is a far cry from 80 to 100%, and that's true. But then again, the XIV hasn't been around very long, and we don't know what kind of events are potentially lurking out there in the future. We really don't know what effect the rise of high-frequency trading could have on VIX futures. The bottom line is, it's impossible to eliminate the inherent risks involved. We can only reduce them. I'm certainly not going to stop investing in volatility products. In my opinion, the reward far outweighs the risk. But at the same time, I do want to be as safe as possible. My tactical volatility strategy only takes the highest probability trades. Only the ones I have the most conviction in, when the odds are most in my favor. And 55% of the time, it's in cash waiting for better opportunities. The strategy avoided over 90% of the worst XIV trading days, which is a great first line of defense against future single-day shocks. And beyond that, the strategy only makes up 25% of the total portfolio. Conservative strategies within diversified portfolios, in my opinion, is the only way to navigate this space. So that's the first volatility pair, the XIV and the VXX, the originals. Now introducing the second volatility pair, and that's SVXY and VIXY. Again, I'm oversimplifying here, but in general, SVXY for bull markets and VIXY for bear markets. VIXY's volume is lower than the VXX, but for the SVXY, it's about the same as the XIV. So even though in the future, people will probably continue to say XIV is the one that's synonymous with short volatility, the truth is SVXY gets just as much execution volume, so it's a good choice as well. So let me go through the areas where the SVXY is different than the XIV. First, the SVXY doesn't specifically mention an acceleration clause in the prospectus, so some people point to that as an advantage over XIV. In my opinion, though, it's best to assume it's roughly in the same boat. My assumption is they will also want to close before the NAV goes negative, so this is probably more or less a wash. Second, SVXY does have options available, so that's something to consider. Now, I made a video recently called Option Trading on Volatility Products. I'll leave a link you can check out later, but the punchline was, option trading on volatility products specifically is not all it's cracked up to be. But options are available on SVXY and not on the XIV. Third, SVXY is an ETF, which holds the underlying futures, making the credit risk lower than the XIV, which is an ETN. Now again, practically speaking, we're talking about high-rated banks here, but however small, risk is risk, so SVXY could be considered safer. Lastly, I'm not a tax expert, so you'll definitely want to consult a professional and check out how it's dealt with in your country and your residency. But generally speaking, filing taxes may be more complicated with SVXY because of K1 filings, but again, check with a professional. I've been trading VXX and XIV for 7 years now, since the beginning, and I'll probably continue with them, but SVXY is just as good, so you're just going to have to weigh option trading and credit risk, tax complications, and decide which one is best for you. Moving on to the third volatility pair that I think gets wildly overlooked and definitely deserves a mention is the ZIV and the VXZ. Now, I won't get too technical here, but essentially all of the other products that I've been talking about, they derive their price based on rolling of the front 2 months of the VIX futures term structure. The ZIV and the VXZ are essentially the same, but they use the 4th to the 7th month of the VIX futures term structure. And because that part of the curve further out in time tends to be flatter, these products also tend to move less from day to day. So for anybody who prioritizes safety and reducing drawdowns above all else, the ZIV and the VXZ are very viable options because they may help you achieve that. And I can actually show you a comparison to illustrate. This compares both of my tactical volatility strategies. The main strategy, as I mentioned, trades the XIV and the VXX. The conservative strategy uses ZIV and VXZ. Now, these are different strategies based on different input variables, so it's not just one strategy with the ticker switched out. But you can see that while the conservative strategy returns are lower, the maximum drawdown is much less as well, only 11%. And my favorite risk-adjusted metric, the Ulcer Performance Index, is better as well. So like I said, if safety and consistency is the top priority, then ZIV and VXZ are very viable alternatives. Now, the daily volume on the ZIV is quite a bit lower than the other products, which just goes to show yet again that the financial industry and traders in general aren't overly concerned with risk management. I think ZIV and VXZ are every bit as good as the standard products, and it's a shame that more traders don't focus on them. My guess is, at some point in the future, there's going to be a legitimate scare in the volatility markets, and when that happens, maybe these products that focus on the 4th to the 7th month of the futures will get a little bit more love. Right now, everybody seems to be chasing the highest yield they can get, and sometimes using double leverage products to do it. But I believe that at some point in the future, it's going to be obvious why that's a mistake. Now, I'd like to give an honorable mention to 2 other volatility pairs that, while they're not quite ready for prime time just yet, I think at some point down the road, there's a lot of potential here. And the first one is VMIN and VMAX. Now, the interesting thing here is these are not just clones of the other more popular products. They are actually structurally different. The other products we've talked about focus on the front 2 months of the VIX futures. They essentially simulate a rolling 30-day contract, but the VMIN and the VMAX actually incorporate some weeklies into their methodology. So they're not leveraged products, but since they can bring down that rolling 30-day contract to something in the lower 20s, for anybody who's looking for exposure to the short end of the VIX futures curve, these products may target that more effectively. Volume is still pretty low, and like I said, not quite ready to take on XIV and SVXY just yet, but there's a lot of potential here. And the last honorable mention goes to EVIX and EXIV. These were just launched a few months ago, but they're very exciting products. Structurally, they're very similar to the other products, except instead of tracking the VIX futures, they're based off of the V stocks. This is essentially the VIX for Europe. So instead of the S&P 500, it's based off the Euro Stoxx 50 index. So for simplicity and generalizing here, but this is the XIV for Europe. And while there is a correlation between US and Europe volatility, it's low enough that this does provide an interesting trading opportunity, both in terms of the way that we traditionally trade these products now, but it also does introduce some exciting US-Europe pairs trading opportunities. So they're very new and the volume is still quite low, but I definitely think they're going to gain some traction in the future, so I wanted to give them a quick mention as well. But that's our list of 3 volatility pairs and 2 honorable mentions that in my opinion effectively narrow down the field to just a few of the better ones. Now some of you might be wondering why I didn't include the UVXY or the TVIX. And to be honest, the answer is quite simple. I'm a conservative trader, and those are double leveraged products. In my opinion, you should never trade with leverage, period, full stop. If a strategy can't stand on its own without leverage, then it's not worth trading. Now, this is a shameless plug here, but my main volatility strategy has pulled in nearly 80% a year with no leverage at all, and we're in cash 55% of the time. So you certainly don't have to take on excessive risk to get a great rate of return. Investing in volatility is awesome, and I definitely think that adding a little bit of volatility exposure to a portfolio not only adds diversification, but it can also substantially boost the long-term performance. But if we get too aggressive with it, that same opportunity can very quickly turn into a liability when the markets don't cooperate. Like I showed at the open, I've been doing this for a long time now, and with a primary focus on risk management, I definitely plan to be here for many years to come. So no leverage products, no UVXY, none of that stuff. We're just going to stick to the main volatility pairs, the 3 that I talked about. Couple honorable mentions we'll keep an eye on in the future, but let's keep it safe and we'll be here profitable for many years to come. So thank you for watching. So go ahead and click the link right here, sign up for the VTS newsletter, and when you do, you're going to get full access to all 3 of my trading strategies for a full 2 weeks absolutely free. And if you are new here, please consider subscribing to my channel. Also, if you have any questions or comments, I'd love to hear from you. So go ahead and leave those in the comments section. See you next time.